Last week, we went over the Q2, Q3 JWB market update. This week, we're teaching you how to put that to work when it comes to making real estate investing decisions. Hey, welcome, everybody, to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow. He's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
It's good to be with you too, buddy. We're not in office today. Just a little hiccup. You wanna update people while you're hanging out with the self-care kits over there?
Well, you know what? We had a little family emergency here at the Cohen family. We are totally fine. Everybody is okay, so no need to worry. However, sometimes you think you're going to be in Jacksonville during the day and on Tuesday, and then sometimes you're not. So I'm actually in Orlando. And I'm at my beautiful wife's office here in Orlando. And, they're lucky enough, or I was lucky enough, they made some space for me. So the show must go on.
It's lucky to have two successful entrepreneur power couple marriage thing that you got going on. You got offices in multiple places. You can leverage family. You're doing all sorts of good stuff, GC. I'm pumped that we were able to make this, man. I'm pumped that we can do this. GC, we just did the quarterly market update. We did it 3 times. We did it in the day. We did the encore. Then we did a live one here in Jacksonville. I feel like I know it by heart. 3 core takeaways. First one was the real estate market in Jacksonville is actually down just 1%, but there's something to know about that. What is it, GC?
Well, we have to learn from recent history and understand the effect of interest rates on home prices. And what we all learned was that when you have low interest rates, it pulls forward demand, which accelerates home price appreciation. And we just look back to the years 2020, 2021, when we saw extremely high home price appreciation. But you know what? That wasn't real. It was pulling forward demand that would have happened in future years. And so now we find ourselves in a high interest rate environment. And so when you're in a high interest rate environment, what happens is it's actually pushing back current sales. It's pushing back sales that would have otherwise happened this year. And it delays home price appreciation. So we have this opportunity to learn from this and then to position ourselves in a position of strength to see how we can take advantage of it. And Pablo, you so eloquently explained this Coil concept. Why don't you share the Coil concept with everybody?
Well, first, I will preface this by telling you that when I came home from our live presentation, I was like, I have a new role at the Not Your Average Investor live things. It's sound effects guy. So the way that we explain it is we look back at 1980 to 1982, and we saw this like longer than normal. Don't quote me on are the years correct there? We look back at a 2-year period where longer than normal interest rates happened in the 80s. It was the same increase in interest rates, a shockingly similar drop in demand for
Here's the thing.
houses.
Listen, you're the Coil expert. You're not the numbers expert. All right. So from 80 to 82, we saw interest rates go way up. And then home sales went way down. And then we looked at the data from 2001 to 2023 when interest rates went way up here. And guess what? We found that home sales crashed at almost the exact same rate. So it's not news. But what happened after the home sales crash, Mr. Coil?
Well, what we proved is that after the home sale, after interest rates went down, home prices rose at a higher rate than normal, meaning that it was a coil that compressed, got real tight, wound up, and then just expanded and created higher than normal home price appreciation. And that's what we foresee in the near future. So that was the takeaway here. The first takeaway from the quarterly update. Second takeaway is the rental property soft market is no more. Explain that in 65 seconds, Greg.
Yeah, absolutely. So, the last 6 months, I was just sharing with you guys that, this was a soft rental market. That meant that rents were growing at a rate that's less than normal. That's what a soft market means. But we're able just to share with all of you that is a thing of the past now, both macro and micro stats and just incredible growth specifically on homes rented and occupancy for single family is where we are right now. So it's a great message for all of us who own rental properties right now. And it's a great message as we look into 2026. We feel like we are in a position of strength, mainly because the glut of multifamily properties is being absorbed, which puts single family rental property owners in that position of strength. So, very good things to look forward to when you own the asset, which is what we advocate for.
So that was takeaway number 2. I want to welcome John Wild Thing Bradford, who's in the house. Good to have you back, John. And then there was takeaway number 3, where you actually expanded this data set of downtowns to show the effect of a downtown coming online being the number one path of progress that you can invest in for rental properties. Now that I'm sound effects guy, I'm not going to go into the numbers, but GC, the actual increase in home price appreciation increased, right? After you expanded the data set.
Yes, absolutely. It is the more and more that we look into successful revitalized downtowns and their effect on those who own single family rental properties, the more we find that this is the best way to win in investing in rental properties. Find the right team in the right market, follow this successful model that has worked for decades and decades and decades, but choose your assets around the next great American downtown. And the data showed that those successfully revitalized downtowns appreciated 89% more than the average US market since 2005. And we believe, and the data shows, that Jacksonville is on that path to be the next great American downtown.
Yeah. So when you combine this idea of a Titan coiled, a before a bung, and a rental market that is now doing better than it was before, and this path of progress that we see coming, we have a really bright outlook here on the Jacksonville rental property market. And now it's time to figure out, how do we put that information to use, right? I think, GC, one of the core things we talk about often on the show is that the order of operations for most real estate investors is misinformed. They obsess over where they can find a property for a long time. The market might be a secondary consideration. It might just be like wherever they have a down, whatever they have access to in their backyard. And then they spend, all of a couple of hours maybe like picking a property manager off of Google or whatever. What we've been saying for a long time is that the order of operations is find the right team, find the market that these great teams operate in, and then the property selection should be easy. So we want to show this, but this is exactly it, right? Like this idea of the right team. The right team should have in-depth data around their market that they can present to you and make you understand the dynamics of the market, and proprietary data like we showed in the quarterly market update about where rents are, about where prices are, about where buy behavior is, about where downtown is going, right, GC?
Absolutely. The idea of making this easy and accessible, this asset class, we started out to make this easy and accessible for everyday people. And you can do that when you choose the right team, find out about the market. They'll obviously be able to inform you about the market like you saw in the quarterly market update. But then you land in this really fun spot when you've done number 1 and number 2 correctly. You get to this place where it can be easy to choose the right properties. It can be enjoyable and you can have confidence. It doesn't have to be, a quick decision. It can be something that is thoughtful and relationship based. And at the end of the day, you can do this from anywhere that you live in the country or the world when you follow this order of operations.
Talk to me about the need to make an informed decision in an easy fashion, right? Like most people, the way that I understand it, it's kind of like, well, we have access to this house, and then you got to go analyze this house in a vacuum, and then maybe there's access to another house, and you got to analyze in the background. Talk to me about the typical kind of like selection experience that doesn't exactly meet this like easy criteria.
Well, should we go for the normal way that people buy rental properties, or should we
Yeah.
go for the normal turnkey experience?
I don't know. You're the expert here, bud. What do you think is
All right, well, maybe we'll do both. And then you can cut me off if I'm rambling. But,
okay?
part of the reason why people don't invest in this asset class is because it's very hard. And it starts with just the idea of identifying a property even to make an offer on. I
Yeah.
mean, normally people don't know where to begin. They don't know what market to look at. And within the market, they don't know the neighborhood. So what do? They ask a real estate agent to help, and they end up driving around for sometimes months and months and months to learn and identify. But what we know is when you look when you work with an expert who has done this thousands of times, the information that you need to make an educated decision can be at your fingertips. You don't have to waste months and months and months of driving around and most likely looking at things that really don't matter as far as actual success for your rental property. But it is very normal for it to take 6 to 12 months to be able to actually make an offer, or much less get an offer accepted. So you might be wasting a year of your life actually
Yeah.
getting to the point.
Yeah, and when it's like that, I don't think I can build my retirement around that. That just feels kind of like, oh, I can take advantage of opportunities at a certain time and maybe be able to, like, I don't know, build my net worth, but it doesn't seem very predictable if you're doing that, right? Like for someone to really see this asset class the way we see it as a better retirement asset class, you need to be able to like pick something out based on your schedule, not the schedule of like when there's properties available, right?
Yeah, 100%. If this whole structure, if this whole investment gets too hard, and it very easily can get too hard for people, it doesn't matter that the returns are better or the returns are more consistent. It's just people don't have time and they don't want to deal with it. So people go back to the more normal way of investing. So the when I say the normal way of investing, I mean investing in traditional assets,
The
stocks, bonds,
average,
mutual
the
funds,
average way.
the average way of investing. But the normal way of investing in rental properties is hard. It takes a lot of teammates to be able to put something together. If you find the right properties, you end up putting offers in and they get rejected over and over and over again. It takes a lot of courage to make an offer, and then you get rejected over and over and over. And you do this for months and months and months, and your spouse is looking at you and saying, hey, that great idea you had to maybe build a better retirement account through rental property investing. You had that great idea you had 6 months ago or 9 months ago. You know what? It's really taken a lot of our family time away. You know what? So I'm not so much behind it anymore. And then people retreat back to what is more average. So that's the normal way of doing it. And then listen, if you do get a property under contract, getting it to closing is a challenge. Let's say you close on it, then you have to go and find a contractor to do the work to be able to put it into great rental shape most of the time. And that now you've just turned yourself into a contractor or a general contractor in managing construction projects. And that is not what you signed up for. And then lastly, if you do all those things, you wind up spending some time trying to find a property manager, and then you're hit with some really terrible news, because most of the time when you do that, the property manager does not agree with your numbers as far as how much it should rent out for, or the property manager doesn't subscribe to doing things like signing long-term leases or other things that by listening to this show are important. And you wind up, maybe a year and a half down the road, you probably have the asset, but you certainly are not excited about it. And you definitely are not going to scale. You're not going to realize the beauty of what this asset class can do for you.
So that's the average way of doing it. We want to hear present like that. It doesn't have to be that way, right? Like you can be a not your average investor. We've done the work, right? We've listened to Gregg and his team have put in all this work into the JWB quarterly market update so that it shows that, this is where the market's going. You found a growth market that fits with your plans. You found a team that has this data that can show all this performance. Let's show folks how easy it can actually be to pick a property. What do you think, GC?
Let's do it.
All right, let's do it. So I'm going to be running this thing. Oh, by the way, this is how easy it is. I am a completely tech handicapped person, and this is my first time looking at this spreadsheet today. And Gregg's just going to talk me through it, right, GC?
Absolutely. So this is something that, of course, JWB would be doing for you and preparing in advance for your calls. But Pablo is just this incredible Vanna White over there. So we thought we thought we would test him out, and so I can kind of talk through and direct and kind of guide the conversation. And Vanna over there is just gonna do his thing. So what we're looking at first is the portfolio generator that JWB does for our clients during our normal client onboarding process. So if you're a new client, we would have a couple of phone conversations with you to fully understand your goals and your resources. And our calls would find ourselves here after we made sure that we built a strong relationship. As soon as we're ready, we're going to get to property selection. And so today we're fast forwarding right to property selection, and we're going to assume a few things. We're going to assume that your budget for this investment is $85,000. We're going to make a couple of other assumptions as we do this, just to see exactly how easy it is for us. Okay.
assuming 85,000, you're looking to buy one house, and now we're looking at basically the available inventory that's out there for the for JWB for somebody that's doing this, right?
Yeah, exactly. And this is something that I think many people really ask for. They want to see all of the inventory that's available. And we're really excited to be able to show that to you so that you can be included in the process of how JWB makes a property recommendation for you or and puts an entire portfolio together for you. It's not like, hey, listen, we're just going to show you the one or three or five properties that we think are right for you. That leaves a question in your head. Well, what about the other five? Well, what about the other eight? Why didn't you choose those? So through this process, which every client gets to be a part of, you get to see this. You get to be a part. It's interactive, and you get to make the decisions really with us without us doing it exactly for you.
Got it. So do you see, I know that this has kind of like three buckets of numbers, right? It's got like the or information. I just zoomed in because Nadim asked to see. So I hope everybody can see better. Let me know if you see it. But it's essentially got the typical property information. It's got today numbers, right? Like purchase prices and property taxes and insurance. That should all be baked into the equation. And then it's got tomorrow numbers, right? How this thing will perform over time. Things like maintenance rate and vacancy rate and expected rent price appreciation. All these things that your property manager should have these proprietary benchmarks based on what they've been able to perform on, right?
Well said.
Okay. All right. So where do I go next, Bob?
Yeah. So this is more about showing you how this recommended portfolio is substantiated, how it's built. These are all the numbers. We don't have to spend a lot of time looking through the numbers, but what we want to do is then click on that recommended portfolio tab. And there we go. So now what we're going to is the kind of the final resting place for what the property recommendations are going to be when we get there. But let me explain a little bit about how this page is built so everybody gets comfortable with it. And then we'll start wheeling and dealing and putting this together as a community. We're going to do this together today. So in the top left there, you'll see your client information. Of course, this is our sample client portfolio today. The investment horizon and the time that the client, through their goals, has dictated that they'd like to hold on to the property is 10 years. And the client came to us, let's say that you came to us and said, I have $85,000 that I'd like to invest. The section right below that is the real estate portfolio investment summary. I love this section because what it does is it helps us just think of what we're ultimately hoping to accomplish. You are looking to bring this asset, bring a certain amount of money to this asset class, and it's our job to grow that money for you so that you can look in 10 years and say, wow, my investment grew to a very substantial amount. It helps to remove some of the emotion of what we are doing here, which I think is important to make sound decisions. At the end of the day, this is an investment for you. And just because it's a home and that we all live in a home, it doesn't mean that we have to think about this as us living in the homes that we are going to invest in. And that's important because you are not your resident. Your job is to create a great living situation that somebody else can enjoy, and you need to remove the emotion. So for this section right here, we're going to be able to see when that client brings that roughly $85,000 to this portfolio, how much is it going to be worth in 10 years? And obviously right now it's filled with all the properties, so the numbers don't make sense, but that's what you'll see when we get there. If we go to the right a little bit here to that section right there, Vanna, you are doing incredible. It's important to understand, now that we understand how much our money is going to grow, how does it grow? And that comes down to the 5 profit centers that this beautiful asset class has. And we need to understand which ones are driving most of the growth. And we need to make sure that all of them are positive. And so that's what this section will show us. It shows us our net rental income, our tax savings, our principal pay down, our home price appreciation, and also gives us an overview of the inflation hedging and inflation profiting section, which is the 5th profit center. We even include the acquisition and liquidation costs. Many times investors forget to include this when they're running their analysis, but we include those numbers because that's how you analyze growth the right way. And then ultimately what it does is it kicks out a nice pie chart, so you'll be able to see how much of your growth is determined by the different profit centers. And Pablo, what's this principle called?
The Pac-Man principle, the idea that every time you do this, I mean, right now we have like all the homes in the portfolio loaded in, and even with all of them loaded in, you see that the number one, place that you build wealth in this pie chart is home price appreciation. So when you lay it out in a pie chart, The Pac-Man is home price appreciation. Everything else is the mouth of the Pac-Man.
Well done. So that's at a high level. Now let's get into the meat and potatoes here, right? Us putting together this portfolio of the month. And so Pablo, what we'll want to do. Go ahead.
Before we get into this meat and potatoes of the month, right? Let's address kind of like the criteria for how you pick these homes. First of all, the Maven, Leslie Wilson says, is this a new property selection process? As I recall, my salesperson pre-selecting properties for me to look at, so I wouldn't be overwhelmed with choices.
Yes, this is relatively new. If you go back years in the past, we didn't have the ability to show every single property, to look at 15 or 20 spreadsheets and to make sense of that in a relatively short period of time without making a client's, head explode. It just wasn't conducive. So what JWB would do is do all the work in the background, and then we would come to you based on your goals and your resources and say, just like the Maven said, here are the 3 that we recommend, or here are the 5 that we recommend. So when we built this portfolio generator, part of it was to be able to show and bring everybody into the process of how are we choosing the properties for you. So this is relatively new. And I think it's nice, especially for a brand new client where the trust hasn't been built up as much as some of the clients like Leslie, who have been with us for 3 years, 5 years, maybe 10 years. It's nice for you to see it, I think, especially on the first portfolio that we're building for you.
Leslie says she likes the improvement. Now, when you're showing up all these kind of like options, it's always best to kind of give people a framework to make this decision making, right? GC, what is the framework? How do you sort through all these different options?
Absolutely. So there's 3 criteria that we need to hit to put together the perfect portfolio for you. It starts with number 1 is your highest rate of return. Our job is to be a great steward of your money, and we need to analyze risk, but at the end of the day, we need to produce the best risk-adjusted rate of return. So criteria number 1 that you're going to see us employ through this process today is highest return on investment, highest rate of return. Number 2, we need to have positive cash flow. We need to have positive cash flow in the first year, and we also need to have positive cash flow through the first 10 years of ownership. So number 1, highest rate of return. Number 2, positive cash flow. And then number 3, it needs to fit within the budget.
Got it, GC. So Nadim's going to have to excuse me because in order to fit this in, I have to zoom out a little bit. But so now we're looking at these properties. We got all, 15 of these in here? Something
That's
like that?
right.
15 properties in here. We see in one column the highest ROIs. We see in another column the estimated total investments. And then what was that third piece, GC?
Well, we need to make sure it fits within the budget. Yeah.
Well, why wouldn't we start with the budget first?
That's a great question. So, the first thing we're looking at, of course, is the rate of return. The thing about the budget, of course, we need to fit it within the budget. But, the budget can be, or the amount that you put into a property can be malleable. We might be able to put 30% down for one property, or we might be able to put 25% down or 20%. And so really the reason we start with return is that's the most important thing, but it also gives us the opportunity to later on think of some properties that might be a little bit over the budget, but maybe adjust the percentage down and maybe they become the winner. So if we went just strictly budget first, we might miss another opportunity if we did it that way.
Got it. Sylvia Berenger says, would you include property age in that criteria, GC?
I wouldn't.
Why is that?
Well, I own over 400 properties, and I own more homes that are older, built in the 50s and 60s, some of them built before that. I own more older homes than I do new homes. And so the age of the home is not as nearly as important as I think people make it seem. What really is important is the team behind the home, meaning the construction of the home and the ongoing maintenance of the home, and of course the property management of the home. But there's a reason why old homes appreciate just like new homes do. So no, I wouldn't eliminate based on the age of a home. I would focus more on the quality of construction, of course the team supporting it, the quality of the construction, making sure that we're reducing maintenance and vacancy costs. And the team that you're working with should have all that information for homes that are older as well as homes that are newer. And, of course we do too. New homes have lower maintenance and vacancy costs than older homes do, but it's just you just have to be prepared. And at the end of the day, older homes produce a great return on investment, just like newer homes.
Yeah, and she has a follow-up question saying, "How about the age of the systems?" And I think it bears saying this is for the true turnkey rental property selecting process, right? Like if you were the reason why we talk about this idea that the order of operations should be team, market, property, is because a team is only going to bring you properties that are at a certain standard. If you are taking that decision-making criteria, then what you need to ask on the front end with a team is like, what's the standard that you're bringing me homes at? And I know that JWB has a specific standard where systems that are either, roof, HVAC, like all the mains and plumbing, all the main systems are brought up to a standard where there is no delayed maintenance or anything like that. If you're doing it on your own or you're not doing it with the right team, then you got to really worry about this like standard of what it's at. And you'd be asking these at the front point. So it breaks this system of like how quickly you can go, right? Am I getting that kind of right, GC?
Well said. Great points there. You said it perfectly there.
Okay, cool. So let's pick some homes, shall we?
Let's do it. Okay, so now we know we're going to focus on returns first. We're going to make sure that there's enough cash flow, positive cash flow, and then we're going to, of course, keep the budget in mind there. So let us start with. Do we have 30% down on all the properties on the first tab, Pablo? I just wanted
We
to make
have
sure that.
30% down, GC.
Okay, perfect. So now let's kick it back over to the right there, where we're looking at the net rental income per property. So this section to the right here is really important because what it does is it allows us to look per property and make sure that each of these hits the criteria that we are looking for. So the reason I asked about 30% down is because that's where we typically start when building a portfolio. The relationship between how much you put down and cash flow is really interesting. If we put more down, then we are going to have higher cash flows. If we put less down for that same property, we're going to have less cash flows. So it's interesting when people say, hey, are your properties cash flow positive? I mean, the easiest thing to do is to create a cash flow positive situation. It might be a factor of how much we need to put down. So here we're starting at 30% because properties are typically cash flow positive at 30%. And now we're going to say, okay, well, how many of those properties are cash flow positive? Are there any that are cash flow negative? Which ones can we eliminate? And so there you go. That just highlighting that column right there, that's the net rental income column right there. Yeah, right there. Exactly. So what do we see? All of those are positive, right?
All of them are positive.
Okay. So now as a financial engineer, which is what your JWB teammate is going to be performing for you, financial engineering, when we see that every property is positive like that, what we are going to do next is say, listen, let's test this out and put less down and see how many properties are still cash flow positive. Because when you put less down, your cash flow goes down, but your rate of return goes up. And of course, it's less money out of pocket. So we all like that. So now, Pablo, let's go back to the other tab, the portfolio generator tab.
Okay.
Not that one. Go back. Yeah, go
Yep.
back
Sorry.
to
Newbie
the
here. Newbie
tab
here.
at the
All
bottom.
right. Yep.
You're doing great, Vanna. You're doing great.
25.
Yeah, change that to 25% for all of them. And now go back to that portfolio recommended tab. There we go. So now we've seen some of these same properties that were cash flow positive are now cash flow negative, right? This is the relationship between down payment, cash flow, and of course, return on investment. I don't know if anybody was paying attention, but what we also noticed is that our return on investment, if you want to highlight that column there, Vanna, our return, well done. Our return on investment actually went up for every single property, which is the relationship there. So I did a little planning ahead of time, as you guys would expect, and we have 5 properties that are still cash flow positive at 25% down. I should also clarify that this net rental income column is looking at the 10-year horizon and understanding if it is cash flow positive or cash flow negative. Every property that JWB sells is cash flow positive in its first year. A part of that is our maintenance credit. A part of that is the maintenance credit, which is worth between $4,000 to $6,000 that every client gets. That in itself is delivered to you day one when you own it's actually delivered to you within your first month of ownership. So you get that in the first year. And so by default, every JWB property is cash flow positive in the first year. What we also want to make sure is that it's cash flow positive over 10 years. And that's what the column that you're seeing, net rental income right there, is specifying. Does that make sense, Pablo?
Yeah, it makes sense. It makes sense that at 30%, they're all cash flow positive over 10 years. And then like at 25% is less, right?
Exactly. And the returns are higher. So we're constantly going to be looking at how little can we put down and still be cash flow positive.
Mm-hmm.
right? So there's 5 properties. So let's identify those properties. If you go back to the other tab and let's just rank them out one through 5. We've got the 2 Caroline's Courts.
Let me just delete all this real quick. So we got Caroline number 1, Caroline number 2. We
We've
got
got 8311 Dandy.
Dandy,
We've got Coco, and then we've
Coco,
got Fifth Avenue South.
and Fifth Avenue South.
All right, let's go back to the other tab. So now what we've been able to do is just focus on the one property, or excuse me, just the 5 properties. But out of this, we're going to find one property that's going to hit that criteria. And we're only looking at properties that are cash flow positive. And we know that we have 5 choices that are at 25% down. We know that these are going to have the highest returns as well. And what we can start to do is do a little bit of elimination just based on budget at this point, right? The first one to eliminate is that property on Fifth Ave South. That is a property that's actually out near Jacksonville Beach. And so the market value of that home is much higher, which means the down payment is out of reach for us with our current budget. So we're going to eliminate that one in a second here. The other one to eliminate, and don't change the tab yet, but the other one we're going to eliminate is this one on Dandy Avenue. And the reason there is that the total initial investment is a little bit outside of our budget. It's about $91,000. And for this example, we have 85. So we're going to eliminate that one as well. So if you want to go back, yep, you can go eliminate those 2, repopulate 1, 2, and 3, which would be the 2 Carolines and the Coco Avenue.
Okay.
All right. So now we have these 3 properties, and I just want you to notice how similar the 3 of these properties are in terms of return on investment, in terms of out of pocket, and in terms of cash flow. This isn't a coincidence. Everything you see with JWB is following the same model over and over and over again. We attempt to basically widgetize rental properties at the end of the day. And so you can see this here. The choices that you get to make are all very similar. And this is why clients who buy today are going to be, choose an individual property. But if you come back next week, you're going to see a different individual property that is very similar. And you can kind of see that here. The 2 Carolines.
That's kind of the genius of your models, you see, is the widgetization of all of this, right? Like the idea that you have created essentially you've had to create like an assembly line of new construction and existing properties that you can build to that you can bring to market with a similar investment profile is the big unlock in people like me being able to plan my retirement around this. If not, the variability would be too high.
Exactly. Simple, repeatable. When things are simple and repeatable, it makes it more enjoyable for me because I have to spend less of my brain activity trying to figure something out. I just know it works. And that's what we create for clients. That's how we've been able to do the same thing over and over and over again for just about 20 years.
Love it. So what's the pick here, man?
Well, so you've got the 2 Carolines at 10.8% returns, the Coco property at 10.9% returns, and all 3 of them have positive cash flow, and all 3 of them are within the budget. So what we're going to choose here, it's kind of like, they're all winners, but we're going to choose one of them, and we're just going to stick to our same criteria. Coco has the highest return on investment, which is 10.9%. It's within the budget. It's at $85,000 roughly total out of pocket. And it has the most positive cash flow by a little bit over the other 2 Carolines. So 7636 Coco Avenue would be our recommendation. That would be the choice for you. And this is the one that we would choose for starting your first rental property in the portfolio with JWB.
Boom. So Coco is the winner. This would be easy peasy. If somebody is coming in looking to invest in one rental property, you have a certain amount of capital. That is the exact process you go through. But as we know, I think people come to JWB not just with like, hey, can I look at a property? They look at, hey, can I build a portfolio? And they will bring you, I have this much in my net worth. This is what I'm planning for retirement. And I want this bucket to be rental properties, right? So why don't we go over like a one-shot portfolio builder here, GC?
Okay.
How do I do that?
So now, well, go back and add all 15 if you wouldn't mind.
Oh, okay.
And while you're doing that, let's talk about why it makes sense to build a portfolio. If you have the ability to invest more, why does it make sense to buy more properties? Why not just buy one property that maybe costs more or maybe buy it all in cash? Well, there's real value for having a diversified portfolio. We found that 3 properties really is the beginning kind of diversification. It's a magic number that improves your experience. As you own rental properties for longer and longer, what you're going to find is that there will always be things that are happening in your rental properties. Things will always happen. As I mentioned, I own over 400 of them. You can imagine that at any moment there is something happening at a rental property. Some of it's great, some of it's not so great. But when you get to 3 properties, what you'll find is that more often than not, one of your rental properties will have something small that is not going your way. It might be a small maintenance item. What you will also find is that the other 2 are overperforming, because if you build in maintenance costs to happen on every single property, meaning we expect it to happen every single year, and that doesn't happen for 2 of those properties, those are overperforming. And those 2 that are overperforming buoy the one that might have an issue with it. And that's why so many clients, especially who are on this call right now, own so many properties. They all have issues that happen with their properties, but they are not bent out of shape. And it's because they have a diversified portfolio. So there's a real value to getting to 3 properties. You also have the opportunity to maximize incentives. As we mentioned, all clients receive a property management maintenance credit, which in essence is between $4,000 to $6,000 per property. So if you're able to buy 3 instead of 1, well, you're able to get 3 times those incentives. And then lastly, there is a real value to building up your portfolio. When you get to 5 properties with JWB, 5 turnkey properties, we reduce your property management fees from 10% per month to 9%. That's 10% or 9% of the rents that are collected. And that's for the future and saves clients hundreds and thousands of dollars. In fact, when you get to 10 properties in your portfolio, we reduce it again to drop down to 8% management fees. So we get to win when you get to win. So lots of reasons to focus on that diversification and get to at least 3 properties if you can. So all that being said, we're going to run the scenario again and assume that you came to JWB and you said, you know what, I have $250,000 that I'd like to put into this asset class. Go to work. How can we build something?
Do I put the 250 here then on the total money to invest?
Sure. That
Do I
doesn't
need to
affect
change
anything on
this
it.
total number of properties up here?
Nope.
Oh, I just put $250.
Yeah, you
All right.
probably don't. Probably want 250,000. Be tough to do it with $250.
It's gonna be hard. It's gonna be hard. Not in this economy.
Not in this economy. All right, so we should also talk about one other important concept. Let's go to the recommended portfolio tab. Let's go over to the right. Okay, I think we have everything at 25% still, right?
Yeah.
Okay, all right, perfect. Now there's an important concept. Let's go back over to the right. There's an important concept here. Now, when I shared what our criteria is in terms of choosing the right property for you, we focused on number 1, highest return on investment, number 2, positive cash flow, and then number 3, the budget. Well, when we are thinking about building a portfolio for you, we have to think about this in a portfolio mindset. Okay. So a portfolio mindset allows us to do some things that might be a little bit different, but end up with a better return. Specifically, what I want to focus on is cash flow. When you come to us and you're buying one asset, your budget and your goals dictate that one property is what we're going to end up with, we are going to choose a cash flow positive situation for you. However, when we expand and we have, call it $250,000, which roughly will be about 3 properties, well, we have the opportunity to look at a portfolio level and say, how are we going to create the best risk-adjusted return? Specifically, what we're going to allow ourselves to do is to potentially choose 1 property or 2 properties that may be cash flow negative to put in the portfolio if and only if the entire portfolio is cash flow positive and if it creates the best return on investment for you. So we give ourselves some ability to maybe mix and match some other properties that might be slightly cash flow negative that we can put into this portfolio in order to be able to create an overall better risk-adjusted return for clients. Does that make sense?
Yeah, got it. So now you are allowing, since you're looking at the overall picture, we want to maximize all 3, like we want to maximize returns as like the number 1 criteria. You will allow a cash flow negative property as long as it's within a cash flow positive portfolio, and that part is being covered, essentially.
Exactly.
Got it. All right. So how do we do it now, GC?
Well, so what we would do, this would again be done in the background prior to getting on the call. We would come prepared. So I've obviously come prepared for this. What we would do is we'd start with the highest return on investment properties, and we might open ourselves up to maybe 5 or 8 properties, and we'll kind of do a little bit of mixing and matching. For us, for the purposes of this call, I went and I found the 5 highest return on investment properties. So we're going to start there, and now we're going to start to do a little bit of mixing and matching.
So
So
which ones are there, GC?
Dandy, Coco, and the 2 Carolines. The the fifth one actually is the Fifth Avenue property, but I just know that the down payment there on that one is going to be cost prohibitive for us to get to 3 properties with the portfolio, and actually will not create the highest return on investment. So the fifth one would be Fifth Avenue South, but let's just eliminate that to save everybody some time in this
Okay.
example. Does that make sense? Okay.
Yep. Sure. So we're doing with these 4 then?
Yeah. And so these have the highest return on investment. And what we would first look at is and say, okay, well, we know according to our criteria, returns are first, then cash flow, then budget. Let's see how close we can get to budget and cash flows if we just put this portfolio together. In fact, if you just want to go ahead and eliminate one of the Carolines, they're the same exact numbers on the
Mm-hmm.
property. So we're just going to eliminate one of them and we'll just have those other 3. There you go. So if you actually look at this portfolio, Pablo, the number's a little small for me. So, I'm old,
Yep.
almost as old as you, but I'm pretty
Almost.
old.
Mm-hmm.
What's the out of pocket for those 3 properties?
Out of pocket here is $256,039.
There you go. Okay. So our budget is 250,000.
Mm-hmm.
So that's not going to work right off the bat. But our returns look great, right? Our return on investment's basically 11%, right?
11% IRR and net positive cash flow of 13,400 after 10 years.
Well, I'm glad you mentioned the cash flow. That's a significant amount of cash flow.
Yep.
So again, as a financial engineer, what I'm thinking about here is I'm saying, okay, we're close on the budget, right? We're within striking distance. We have a lot of positive cash flow, both year 1 and over the 10 years, and our returns are really high. So in my head, I'm thinking, oh, wow, I wonder if we adjust how much down we're going to put down for one of these properties, if we can fit and maximize our returns, still be positive cash flow, and fit within the budget. Okay.
Yep.
So that so that's what we should be looking at. That's what you should be looking at when you're thinking about crafting your portfolio. And Pablo, do you think normal real estate agents, when they're driving people around, are analyzing it this way?
No, that's a mind opener for me, right? So like now that I'm looking at this thing, if I'm seeing the logic of what you're saying is, if we were like way off in this total initial investment, we'd go back to the drawing board. If we were way off here and like really tight on cash flow, we'd go back to the drawing board and pick properties. But since we're so close on the investment and so high on the cash flow, it bears asking the question, what if I lower my down payment for one of these homes? That's what you're saying.
Exactly. Exactly. It goes back to the first question you asked me. Why do we not just eliminate based on budget right off the bat?
Yeah.
Well, it's because we want to give ourselves some flexibility to maybe adjust some things. This is a great example of why that's important.
Yeah. Got it. So do I go back to the portfolio generator here?
Yeah, yeah. And then the next question is, okay, if we drop it to 20% down,
Mm-hmm.
will we still be cash flow positive? So we're going to run through a few scenarios here because we'll find out if the answer is yes there in like 2 seconds. But then we'll decide, okay, which of the properties should we put 20% down in order to make
Uh,
this work?
okay. So am I going to do one at a time or should I do all three 20% down right now?
We'll just do one at a time. Go to the Caroline's Court one and put 20% down for that one.
Just at 20% down for this one.
Okay. All
So
right.
now we have 11.1 internal rate of return, went slightly up. The down payment is now well within the budget, right? It's now
Mhm.
244,000 and total cash flow went down about 10 grand total to 5,335.53.
Well, there we go. Does that meet our criteria?
Definitely meets the criteria. Should we do with
Okay.
the other ones and see which one's better?
We certainly should. We certainly should. So in scenario 2, go ahead and bump Caroline's back up to 25%. Now put Dandy at 20% down.
Aha. Same IRR, lower down payment, but lower cash flow. So we probably stick with Caroline for right now.
Yeah, exactly. Right. Well, let's
Okay.
run scenario 3.
This is so easy.
So
Once again, lower down payment, 11.1, similar return, slightly lower cash flow. So the one with the highest cash flow, highest return, and closest to the down payment number, is if we use Caroline as the 20%.
there you go. There you
Isn't it
go. Right.
simple?
At the end of the day, we're right where we need to be. We're well within the budget. Our total out of pocket is 245 on this one.
Mm-hmm.
It's the highest rate of return that we can find, and we were able to maximize that too by using some financial engineering and putting 20% down on a property, and we were still able to generate positive cash flow year one and positive cash flow over 10 years. And now this client's going to walk in with 3 property management maintenance credit, and then of course be on their way to hopefully getting to 5 properties and 10 properties in a manner, hopefully in a short period of time.
That seemed pretty easy, man. I like the ability to do the different variations. At what point would you go back to, like, based on what we just did there, why wouldn't I then go, well, what if I find another property that might actually get me like right up closer to 250 and like try it that way? Is that just kind of like a feel thing?
Well, that's what I was doing in the background before the
Yeah.
show. And so I think it's a pretty fun process when you're on the phone with the JWB team. You can
Yeah.
ask those questions and
Yeah.
you can say, hey, well, what if I plug this property? And what if one question somebody might ask is say, well, what if we put 20% down for 2 of those properties? Wouldn't I increase my rate of return? And the answer is yes, you would. However, if you put 2 of those at 20% down, well, it would have been overall cash flow negative over the
Mm-hmm.
10-year mark. So this is the fun part. If you're a nerd like me, and I know we have other fellow nerds in the audience who love numbers and being financial engineers, you can kind of have a field day together with JWB and you making the decision together. And if we relate this back to the ways that clients are successful, the way that rental property investors are successful with JWB versus the average way, it's because they land in property selection and it's easy, it's enjoyable, and they have confidence as to how they made the decision. And they didn't have to do it the average way. They didn't have to go and beat their head up against a wall for a year going and try and find properties, and of course getting rejected and all those things. So this is how it can be fun, easy, and enjoyable.
Pretty cool, man. John Williams, Il Maestro, says this is awesome. I like the flexibility of doing this. Can we do a couple of Q&As here that some are before we get out of here? We got a couple 8 more minutes.
Absolutely. And did
Uh,
you want to, while we're doing that, do you want to give people the little virtual tour too? I know folks will say, hey, do I get to see a picture of the property? You want to
Oh
kind of do that as
yeah. Oh
well?
yeah. I forgot about the fact that you can just click on one of these, right? Like let's say we want to click on Coco and it'll take you to one of these little virtual tours, right? So you're not
There
just
you
looking
go.
at the numbers, you can see the property itself and do your own little walkthrough.
There you go. Save yourself a year of heartache.
Save yourself a year of heartache. All right, how do I get out of here? No, I'm in the bathroom now, GC. Hallway. This is where I get stuck. Kitchen, maybe? Do I go to the kitchen and then the living room?
There
Yep.
you go.
And then now we get to go to the front yard, and now we're out back again. Oh, front yard. Here we go.
There you go.
No, virtual tour of all of these. I had actually pre-clicked all of these. You see them on Zillow. You see the virtual tours. Pretty easy to follow. How did I
Pretty
do?
cool, right?
Yeah, it's
You did
pretty awesome.
great, man.
It's
You did
pretty
great.
awesome. All right, let's jam through these questions.
Okay.
John Wildthing Bradford says, "What if you come in and start with 5 or 10, and say you want to use the C3X method in here?"
Oh, I love that. I love that. So the C3X model is a way to accelerate your pay down. So once you own the assets, JWB can help you choose which assets do you want to pay down in order to decrease the amount of time it'll take you to pay off your loan. So that's typically a process that comes after the initial property selection. And we get to meet with clients. Typically we'll meet with clients on an annual basis and kind of adjust and say, okay, have the goals changed? What are we doing with our debt pay down? Has anything else changed? And so on an annual basis, we kind of direct and say, okay, well, you know what, instead of you paying, listen, debt pay down may or may not be the right strategy for everybody, accelerated debt pay down, but let's say that it is. We'll actually say, instead of paying a little bit across maybe these 5 mortgages, let's take all of that extra cash flow that you have from your rental properties or even outside of your rental properties, and let's focus on one of these loans. And we can show you how by doing that, all of your loans would get paid down in less time. So that's a part of our service. It's just typically done after the initial, selection of properties, and usually more for our current client and then on an ongoing basis for clients.
Very cool. Very cool. So yes, John, wild thing. You can definitely do it based on the C3X if you're coming to the table. I guess it wouldn't be, if you were to do like 5 or 10, it wouldn't say I'm looking for 5 or 10. You'd say you'd still have to go with budget as well, right?
Well, yes, if we were choosing 5 or 10 properties, the process that we just walked through would be the exact same. The numbers would be larger, but the concepts of how we would build the property portfolio would be the exact same. The next step, when you have 5 or 10 properties, we would have the next step, which would be, okay, John, your portfolio is kicking off, X number of $1,000 per year in positive cash flow. What are we going to do with that? And if your goals dictate that we should focus on accelerated debt pay down, then we would help John and say, okay, well, out of these 10 properties that you now have, we're going to take these, I don't know, $5,000 in positive cash flow per year, and we're going to choose one of your loans to attack and pay off. And by doing that, it's going to be paid off much quicker. And then what's going to happen is that loan is paid off, your cash flow goes up, we roll it into the next one, that one gets paid off even quicker, and so on and so forth. So it's still a part of the process. It's just more of, after we own the assets, what are we going to do for the next step when it comes to C3X?
Got it. All right. Patron Santorios, Michael Santorios has a policy question here. Greg, Federal Reserve Powell spoke before Congress this morning and indicated that the current interest rates could be sustainable and expressed no rush to cut rates. Today's rates are 4.33%. The average Fed rate from 85 to he didn't put another number there. Current, to 85 to current is 5.3%. What are your thoughts on whether the current Fed rates could become the new norm and how this might impact pricing?
Well, the more we think we know about what the Fed is going to do, the less we know. So I don't spend a whole lot of time wondering what the Fed is going to do. What I pay the most attention to in terms of real estate and interest rates, what I pay the most attention to is the 10-year yield, the 10-year treasury yield. That is actually what determines mortgage interest rates. That, along with the spread, there's a mortgage spread. And so those are really what drive the interest rates that we have on our mortgages. So, we have seen times where the Fed actually drops interest, the Fed funds rate, but mortgage rates went up. That's actually what happened the last time the Fed dropped the rate. So I guess my answer would be, I'm paying a lot of attention to things outside of the Fed, because that is what is driving our 10-year treasury yields to be higher than we all want. If 10-year treasury yields come down, our 30-year mortgage interest rates come down. Would it be nice, strictly in the sense of helping the real estate community, would it be nice if the Fed also dropped rates? Yes, I would certainly welcome that. However, there are ways for our overall mortgage rates to come down even if the Fed doesn't drop rates. That's kind of the way I'm thinking about it.
Got it. Okay. John Walting Bradford says, are the net rental income figures taken into consideration the expenses, i.e. management fees, loan payment, etc.? Just wants to confirm.
Yes, absolutely. All of those expenses and then some that you probably haven't listed there or thought about, they're all included there.
And then Sylvia Berenger says, this is a very transparent model. Thank you very much.
Well, thank you for being on the show. I'm glad you enjoy it.
Good stuff, GC. How'd I do? How'd I do modeling as the Vanna?
Well, you did great, man. Can we just revisit what the end of the last show that we did, the portfolio of the month, looked like? How much was I sweating at the end of the last one, just because I was trying to do what you're doing?
I had forgotten about the radiator that I had next to me and like the just emanating absolute, like, yeah, you were definitely sweating. It was visible on the Zoom camera, and up next to you, it was damp out there, man.
It was a lot. It's a lot to handle when, we're trying to be able to teach, but we've got technology and then there's public math, which is hard for everybody, and you don't want to look like an idiot in front of all of our community. So there's a lot of that going on. So brother, I super appreciate you carrying the burden there. And I don't know, I'd love to hear from the group. Do you guys like this? We want to bring this back, on a regular cadence and just kind of like, obviously, teach a little bit about the portfolio mindset, but also bring it a little bit more tangible about how do we choose the individual assets. Does everybody kind of like this? I'd love to hear it in the chat.
Yeah, yeah. We see this. People are saying, yes, great info. They liked it. John Williams, El Maestro, says, I did so good. It's time for a promotion, Greg. So just think about that. Ernest Gadagas says, came late, time difference. Yes, on bringing this back. The Rileys are regulars. They love it. Nadeem Shah says, everyone have a great day and week. Happy investment. Ronald Twing likes it. El Gran Amigo, Bill Shields likes it. Roger Evans likes it. So yeah, I think this thesis of like, oh, Sylvia saying, yeah, bring this back every quarterly. So yeah, we're going to definitely bring this back after the quarterly market updates. And I think we're also going to start using it as like, hey, let's do like a scenario, do different scenarios like portfolio of the week. Should be a lot of fun. Like, hey, let's do this as in an STIRA. Let's do this for like a 1031 exchange, right? Like we can do different use cases. I think people are going to love it, man.
It'd be great. And if the community has things that they would like to, contribute, like to make that the basis of a future show, and we bring this portfolio generator and say, how would we do this? We are always open. We would love your thoughts, your ideas on great show topics, and this can be a great one.
Yes, Ernest Gadagas is asking, was this recorded? Ernest, I just put it. So we do, yes, this is recorded. We do it live on YouTube. It's live on YouTube right now. My team will post-produce this and post it new on YouTube, but in the link in the chat, you can already click on the live YouTube that you can watch right now if you want. Agnes is asking the same question. So you can rewatch this. Next week. I don't know if anybody noticed, but we are already in the second half of the year. And that means that there has been these like second half of the year forecasts and reports. So we're going to dive into the different reports of what people are saying, second half of the year predictions, 2025. And we're going to put a little what GC data plus perspective from old genius concepts over here. We're going to give our own takes on these things. So very much looking forward to the show. Hope you join us. Want to thank the community who comes here every single week. You are investing an hour of your time in the middle of the workday. We don't take it lightly, but you add so much value to the show, asking great questions, coming and getting educated, acting like a not your average person. So from here until next week when we hope to see you, what's the advice, GC?
Don't be average. See you, everybody.
See you all next week.